was, what do I think of Yellen? She is, I'm going to say she's an academic. Yeah, that's where she comes from, different ways. I don't know her very well, so I'm not going to pretend I do. She was one of the first people, though, inside the Federal Reserve that understood that we were in the middle of a housing crisis, and that was coming. She started talking about it in 2007. She is right now dovish, really focused on the unemployment rate, and so she, all the comments and different things is that she's going to keep interest rates lower longer. That's kind of her impetus. My personal perspective, though, is I think she's more pragmatic than what people give her credit for. So I think if the economic conditions change, she'll do what needs to be done that are going to be out there. But right now, a lot of people inside the Federal Reserve, and I think she's one of them, has been looking at we need to get people back to work, and we're focusing on the unemployment rate. So that's where the direction and that's where the focus is right now for many of them. But I think she has a tinge of practicality in her. If the situations change, I think she'll do a different policy and make it whatever's needed. Yeah, you get a follow-up question?
What's your opinion of what the health care bill is doing to the employment situation?
Okay. The question was, what is my opinion of what the health care bill is doing to the employment situation? From my perspective, it is changing the dynamics of the workforce. Talked to many different businesses in previous work environment and today. You have businesses that are now at 49 employees and they don't dare to go to 51 because that triggers healthcare in there. You have many people limiting workers to 30 hours, keeping them part-time. So you're having workers that are doing two jobs, trying to do different things in that. I think what it does is it doesn't encourage employment. It's basically limiting types of employment because we know that when you look at growth in jobs coming out of recoveries, it comes from smaller entrepreneurial firms that grow. And when you're capping and that healthcare is a big bill, they're not going to grow above 50 workers. And so you're limiting a cohort of potential businesses that would look to grow but won't because the costs go up. So I think that's a challenge in that, just for those two reasons.
Jason, I've got one here. The question is, what about the stock market?
So what about the stock market? Well, I think what you're going to see is, I think on average, you're going to see a lot of dynamic shifts in the stock market of what's driving it. So if you look back to what happened this last summer, the Federal Reserve just started talking about tapering, where they were just going to, they're not shrinking the balance sheet at all, but instead of adding $40 billion a month to the balance sheet, they're just going to slow it to $35 billion. They even started talking about that last summer. The stock market did this. Right? So what's going to happen? You get in a higher interest rate environment, that's going to put downward pressure on the stock market. But what is the only reason that the Federal Reserve is going to start tapering faster or shrinking the balance sheet or raising interest rates? They're only going to do it if economic growth is picking up. And if economic growth starts rising, business earnings start going up, what's going to happen to the value of the stock market? That's going to go up as well. So I think it'll kind of balance out those two, the downward pressure versus the upward pressure in terms of the growth. But you're having those countervailing forces, and sometimes one's going to be stronger winds than the other, and then it's going to go back and forth. So I think you're looking at a period of probably some volatility in the stock market, especially when you get these turning points in the economy and the volatility that's going around. So I think that's what you're going to have for the stock market, is going to be some of that volatility, and hopefully the earnings growth that we have will offset what some of the downward pressures from the monetary policy and lower interest rates, or higher interest rates. Higher interest rates cut asset values of all classes, not just farmland.
I have two questions. One is land use.
Okay.
Okay, the other is if you had an opportunity to invest money for 7 years at 5% return, would you do it?
Okay. So the question was, he says, has land peaked? And if I had an opportunity to invest money for 7 years at 5%, would I do it? The second one, yes, I would actually probably do it. The first one is, has land peaked? I think it probably is hitting that plateau. I think it's there. My best indicator that I use for it is I try to gauge the number of failed sales out there in the countryside at auctions. Because if you're getting failed sales, that means people are not hitting that reservation price of what sellers want to sell, and you probably had that peak. Now, I don't know what some of the reservation prices are, but that's kind of where it is. I'm starting to hear of more incidences of failed sales that are happening out in the market. We're not getting the big, we're getting some increases in land values are still rising in some places. Other places I'm hearing land values starting to go down a little bit. I think it's the difference between probably the quality of land. I think you get your first declines in the poor quality land, while the good quality land is going to rise for a little bit and it'll kind of average out. So I think we're pretty much generally in the peak. It'll be interesting to see what happens through this next year. But I think right now, I think you're going to look at a plateau for a while and see what the market plays out.
So when you say for young farmers now that, like you said, interest rates are gonna rise and land prices are gonna go down. So wouldn't if they buy it now at lower interest, wouldn't it kind of equal out in the end?
Yeah, so the question was, if you're a young and beginning farmer, if you buy it now, you have a lower interest rate, you have a lower payment, doesn't that equal out kind of where it is in the end in terms of where it is? Depends how you're able to structure it. So it's all about the financing structure. If you're able to get a good, decent down payment, it probably pays out, especially if you're able to get it on a fixed rate for a long period of time going forward in there. And then it also depends upon how far land values do correct. Is it 15? Is it 25? Now, a lot of different things, my colleagues at the Federal Reserve, or not Federal Reserve, but at the Purdue came out looking at 25%. I've been talking to some land investors, non-traditional investors. I've asked them, they've been trying to buy land. I've asked them, what are they buying? What are they thinking? They were putting in a correction of 10 to 15% when they buy land. So if you get it structured right, I think it works. Especially now, if you get a couple of years of decent profitability and income, I think it works out on there. But I think a lot of it is how you finance it, with that long-term interest rate locked in. The other aspect of it is from my standpoint, I'm not saying debt is bad. And I want to be clear on that. If you're expanding your operation, you have a business plan, the cash flow justifies the purchase, and you can finance it through, make the investment. But just be careful about how much leverage you have in your whole operation. There's too much leverage. There's also not enough leverage, because you're passing up on growth opportunities. And you have to find that sweet spot. So it's kind of like that Goldilocks scenario. So you have to figure out where you're at on that profile.
I have a question over here.
Yeah.
What are they going to do with section 179 for 2014 and going forward?
I don't know what they're going to do with that going forward.
I have a comment, not really a question. A lot of people on a fixed budget, energy prices going up, food prices going up. What's going to determine, what's going to control that budget? I mean, they're going to have to choose between eating or keeping warm.
So the question here was people on fixed budgets or fixed incomes, and the choices that they're going to have to make with rising inflation, higher inflation, and living costs. They're going to have to make some tough choices. And that is the one thing that, when I was at the Federal Reserve, I came from the Federal Reserve Bank of Kansas City. And that was the bank that I would, for the last two bank presidents in the cycles, those are the bank of the great dissenters, of dissenting against monetary policy. Because interest rates at this low of a rate are very disruptive to the economy. Number one, people on fixed incomes that rely on the rate of return and the interest rate as their nest egg, as their living expenses, have no income, and so they have to get into the principal to live. And that's devastating. Number one. Number two, interest rates are the price of money at zero. If I told you that we were going to drive the price of corn to zero, would you tell me the market works? So why do we think that we can drive the price of money to zero when we think the money markets are going to work? And the other aspect of it is, when you drive interest rates to zero, and people need income, they start searching for investments of higher rates of return. And there's usually a risk-return relationship. To get higher returns, you put on higher risk. Wait a minute, wasn't that what we did between 2005, 6, and 7? We pushed interest rates down to 1%, and everybody was searching for houses, and they're searching for rates of return, so they started investing in houses and in mortgage loans, and then they started doing secondary loans, and then the mortgage brokers got into the business and started collecting fees off loans and then selling it onto the secondary market, and then they went even a step further where they had no document loans, or my favorite is what we always called ninja loans: no income, no job, no assets, you qualify for a home loan. Because we were trying to turn the loans to generate fees to support the business because we needed the income. That's one of the things. When you misprice anything, corn, money, you distort markets. And ultimately you'll get some bad outcomes. So yeah, that is the toughest choice. It's being discussed inside the Federal Reserve. It has been discussed. And they're looking at it when the votes come at the end of the thing and where the votes lie out. The group that looks at lowering interest rates to try to stimulate lending activity, to try to stimulate loans and jobs, that's the argument that at the end of the day is winning. But there's a whole other cohort of people inside the Fed that are talking about what low interest rates do to fixed incomes and limiting incomes and rates of return out there and distorting the money, financial markets with low interest rates. Yeah.
Where would we be without the Federal Reserve putting out the money that they had in the last 4 years?
Yeah. Where would we be if we were without the Federal Reserve putting out the money the last couple of years? In my perspective, I think we would be in a worse financial condition. It's been propping up. We've been pumping up the economy and keeping that balloon going out there. So we would be in a worse financial situation. My whole thing, though, is if I go back to the balance sheet. Oops, what I really liked the green. We provided loans to banks to get through the liquidity situation, and when they got through the liquidity situation, what'd they do? They paid back the loans, and the green disappeared. I think the real problem from the Federal Reserve standpoint, it's the red. It's the housing market. It's the mortgage-backed securities. That is the real strain that we have, and how do you shrink that portion of the balance sheet? It's going to be, we can sell a treasury. But it's the red and the mortgage-backed securities that are going to be really tough to sell without taking a haircut or a discount. And I think that's one of the challenges that's going to be out there. How do you do that? How do you have rising, because it's going to take higher interest rates to sell that portion of the balance sheet. Yeah.
The 2% inflation that they always talk about, is that real number or is that skewed? Because just what that fellow was talking about, you know, I mean, I look at all my expenses, they've gone up considerable. I look at the price of land, it's gone up considerable. And I look at, you know, even buying land, you know, I bought a farm in '90, and I was able to get the $100,000 to buy it. I bought a farm 2 years ago, I was able to get financing $1 million to buy it. To me, being a simpleton, it seems like money's worth 10 times less. You know, I could get 10 times more money. You know what I'm kind of trying to say?
Yep, I know what you're saying. So when he talks about the inflation rate, is it kind of a mixed up number and made up of that? And yes and no. So it is measured basically the same way as kind of what we talked about over time. When I was at the Federal Reserve, we didn't look at just one number. We had like 15 different indicators that we looked at, and they were all kind of coming up with the same figure. That said, some of the stuff that goes inside of creating an inflationary number is really hard to come up with reality. For example, they've tried to adjust it because the value or the productivity of the vehicle that you buy today is a lot different than the vehicle that you bought 10 years ago. But they have to have some type of factor in that. The other aspect of it of inflation is that the big component of it is housing. But it works the opposite of what you think. They don't use home prices to calculate the housing number for inflation. They use the cost of rent to rent an apartment. So what happens when people start buying more houses? The rent number goes down, right? So what happens to overall inflation? It goes down, but that completely misses the point that when people are buying more houses, we start building more houses, lumber costs go up, so do shingle prices go up, cement goes up, you have all these things that are happening. The other aspect of it is that when you talk about inflation, it comes from two components. Number one is supply side, cost push. What's been happening over the last decade? The value of commodities have been going up, right? So, and you're in the commodity business, so everything you've been dealing with, the costs have been going up. The other part of inflation is what I call demand pull. It's people bidding for goods and services and pulling the prices up. Okay? The key component to that is wages. Have wages been increasing? No. So you're not getting demand pull. Okay? So if commodity prices are going up, if we ever get wage growth in the United States, what's going to happen to inflation? It's going to go up, and it's going to go up fast. It's going to go up with the value of inflation. Now, in my personal thing, I think we're starting to see some wage growth in very specific places. For example, if you have a college diploma, in the United States, your unemployment rate is less than 4%. If you don't have a high school education, your unemployment rate is greater than 11%. I remind my kids of that every night to make sure that when they graduate that they don't come home and live with me. What we're seeing is that in certain aspects, if you have a college diploma, you are starting to see wages start to go up. Especially if you are an engineer, computer technician, if you're a welder, if you have a technical trade, we are starting to see those types of jobs starting to increase and rise and starting to see the wages. Which leads to what? Fancy term is called bifurcation of the income stream in the United States. We're getting two classes of people, right? We're getting those without a high school diploma, those don't have a job, and those that are on low income. And you're getting those that got some type of technical degree or a college education that are getting higher incomes and higher wages. And that is a big challenge for our society as a whole. how do we keep the kids in school? How do we make sure that they go through and get the high school education? And strengthen the school system so that they know that when they get done, that they know that they're going to have opportunities for higher income and a higher quality of life. I think that's just a big societal issue, a big societal challenge that we're going to have to tackle. It's going to be tough. So, long-winded story. We haven't seen it's there. It's on the commodity side. It's the cost push stuff. As soon as wages pop, we're going to get inflation. It's coming.
Would it be a good idea if I didn't give these guys a pay raise this year, trying to keep them?
I was afraid he was listening to that part.
I know. That's what that's what they keep telling me too. I think it's one of the things where, when somebody kind of similar to that, people have kind of said, so what's the long term, what's the best way to get out of this? Okay? And one of the biggest challenges, I think the Federal Reserve has really set us up that we've got to play the Goldilocks scenario. Not too hot, not too cold. We've got to have it just right. We need growth between 2.5% and 3.5%. Because if you get above that, all of a sudden you start seeing wage growth and you start seeing inflation going up. And when inflation goes up, what is the Federal Reserve going to have to do? Tamper it down. But if you get growth too low and too sluggish and below 2.5%, you don't get the job growth and you don't get the incomes that allow us to strengthen the economy and shrink the balance sheet. It's walking this fine line of the Goldilocks economy, of where we want it right in that middle sweet spot. And that is just going to be really, really hard to do. And one of the real challenges. In many ways, we're halfway through the Great Recession. Because we've expanded the balance sheet, but now we've got to shrink it. And that's the hard part of shrinking that aspect of it. Yeah.
I noticed in our small town, we've got 4 or 5 foreclosures. I got to go back on the market. There's no for sale sign in the yard.
Yep.
We're just now starting to see some notices in the back of the paper. Do you think there's another round coming with foreclosures?
Okay. He was talking about the foreclosures. We have another round of foreclosures that are coming. He's seen some of them come through. Looking at the numbers, we're going to have some foreclosures through time. Coming off with this, just the way the loans were structured at this point in time. You think about 2009, people were able to get variable rate mortgages. When were they being reset? 5 years out, maybe 7 years out, 7-1 ARMs. So you're looking at, let's say you've got a mortgage in before the crash, say 2008, okay, or right before it, and it was a 7-1 ARM. So your interest rate doesn't really reset until 7 years later, that's 2015. So you still got that system of home mortgages that were back before the crash that we've still got to work through that haven't even gone through yet. So there's another wave in there. It's smaller than what it was for previous years, but there's another wave that is coming on that aspect of it. Now, what we have been seeing is that some of the places where they've had the worst collapse in market prices have been starting to come back around, doing different things. Again, if you go watch HGTV, some of the shows now, you're starting to see some of the flipping shows come back on. But what are they doing? What are they buying? They're buying foreclosed homes, or they're getting them off the courthouse, right? Okay? So that's where the market's starting to come back. The floor has been hit, the floor's been set, they're buying the bottom feeders are in, and they're starting to come off and come up on that. You're seeing some places getting the incomes going on. Florida's market's come back a little bit, and different things like that. Here in the Great Plains region, in mid-America, in the middle part of America, and here in Siouxland, you don't get very many waves. It's been fairly steady. So that's not going to have too much, but some of those worst pockets, you're starting to see the home prices come back. Yeah.
Dollars reserve currency status.
Great question. Is the dollar losing reserve currency status? From my standpoint, no. And I don't think it is. So what's happened over the last week? You've had people pull out of equities, and what have they been buying? Treasuries. Okay. So concerns about economic growth across the globe, they still buy U.S. Treasuries. When it comes down to the reserve currency, I think there are a couple of factors that are really dominant and really drive that. Because when you're the world's reserve currency, it's all about when you get in trouble in the global economy, where do you put your money? Okay. Well, you put your money in a place that protects personal property rights, and you put your money in a place that has institutions that are fairly stable. Well, we protect personal property rights, and every time that we change presidents, we don't go out and shoot each other. We're fairly stable. And the rule of law generally rules in here instead of the rule of the gun. So you're going to when things go bad, you put your money in the United States, or you're going to put your money in Venezuela or some other countries. And so I think other parts across the globe, to take away our reserve status, have to tackle those major things, in addition just to having a stronger growth. They might want to become the world's reserve currency, but it's not something that you take. It's something that basically the world grants you because of how you conduct yourself and the institutions you have. Yeah.
With all the publicity that our national debt gets, and you look at your charts there, how bad off are we as a nation?
So the question is given these charts, the one thing that I haven't talked about is debt. How bad are we? We're flirting with a really bad situation. If you look at projections, our debt to GDP ratio is at 100%. Usually across the globe, in general, if you get around 100%, that's when you start having problems. But the projections are, if the forecast of interest rates goes higher, we don't make adjustments in the benefits that we've promised ourselves, we don't limit our spending, and we don't get stronger growth, we're looking at debt to GDP of 300%. Okay? Japan is the highest in the world right now, and they're at 200. You get about 120, you're looking like Greece. So those are some of the things that we worry about. What are the two biggest things on that debt growth going forward? Number one, it's entitlement programs. It's not Social Security. It's Medicaid. Medicaid is going to be the big challenge on the debt side and on the spending. The other aspect of it is, if we get higher interest rates, servicing the national debt will become the biggest expenditure that the federal government has. And it gets to the point where we can't service it. It'll be really hard to do it. So think about this picture. Interest rates rise. Okay, inflation takes off, right? Federal Reserve raises interest rates. What does the federal government do to the Federal Reserve? Puts pressure on them to keep interest rates down. Well, what does that mean? That means we get inflation, which means we're trying to monetize the debt. And if you go back through history, that's never ended very well. So I think from the Federal Reserve standpoint, when inflation comes and interest rates rise, they're going to have a huge political pressure on monetary policy, on whether they can raise interest rates and the trade-off between higher interest rates and inflation. And inflation is its own tax. So I think that that's another dynamic that is associated with it as well. I think from the debt, we have to do a couple of different things. It is so large just from the math. We have to figure out a way to cut spending, and we have to figure out a way to raise revenues. The only time in the last 20 years that we've had a surplus was the late 90s, when we grew the economy faster and generated a lot of income. We have to get our economy growing faster. We have to do things that create jobs and create income. And that should be the number one thing that we're looking at. One more?
We talked about the budget and Medicaid, but that's one of the big pushes is the Affordable Care Act is pushing this Medicaid. It's gonna blow up.
This question is in the Affordable Care Act, one of the big pushes was Medicaid, and that you have a dynamic where the policy is pushing Medicaid and increased spending on one of our biggest challenges, and how does that square with it? And from my perspective, it exacerbates the challenge that we face. It's going to be really tough, but as a society, we have to really rethink the benefits that we've promised ourselves. In many ways, it's going to be some shared sacrifice. Everybody's going to have to think about the benefits that are promised. For example, how many people are under the age of 40? Okay, good, everybody raised their hand, that's awesome. All right. But under the age of 40, are you betting on Social Security being there for your retirement? No. Isn't that changing the benefits we promised ourselves? I think there's going to be some tough questions that need to be asked about entitlement programs and all the way across, because it comes down to the point of, are we really rich enough to afford what we've promised ourselves? And if you're not, you look at the farm crisis in the 1980s, you weren't rich enough to afford some of the things that we had bought the previous decade. And it's the same thing, kind of just in a different perspective. So we have some challenges that we have to deal with. We have on the debt picture, we have a few years to work with stuff, to get our financial house in order, to get a long-term plan for the debt and how we're going to manage it. But we've got that window, it's pretty short, and it's shrinking each and every day, and we've got to act to do something. And it's about limiting spending, and it's about thinking how we're going to really generate revenue. And that's by getting people jobs and income. I'll keep going. So.
Talking about spending, when are we going to learn that we can't afford to fight these wars? We can either win or.
No, I think that's a big thing too. What are we spending on? We've got wars, we've got many different things and many different programs. I think it comes down to where's our rate of return. You talk about it. I mean, this is the classic economics 101 class of guns or butter, right? Guns in other places a lot of times don't generate a lot of return on investment. And so for me, I think when the federal government looks at how it's spending its money, and even state governments and local governments, what's the return on investment? I think that was the biggest thing in 2008. We had the huge stimulus package, and we were told that we had shovel-ready projects. They weren't shovel-ready. Even though infrastructure has one of the biggest returns on investment. Interstate highways and roads, railroads, airport systems, lock and dam systems that are over 50 years old that need fixing. Port facilities that allow us to get our goods and products out of our country to meet global demand. In many ways, we got to go back to when a lot of that was done in the 1950s. Going back to the 40s and 50s again, and relearning the lessons of history, of what set us up for the next 50 years, of thinking about what infrastructures and the great rates of return that we have from that in our country that could set us up for the next 50 years. that's my personal bias on there of what we can do, what we can think about it in there of where are we going to get this rate of return and return on investment and long term, not just short term stuff. So yeah, the wars are another challenge.
Why do you think sequestration is still in place, and how much is it helping lower our debt?
Sequestration. Yeah, it is in place. They kick it down the can. They relax it every time they kick it down the can, kick it down the road. It's in place. It's been slowing the growth of, it's just been slowing growth of debt accumulation. It hasn't been solving the problem. It's just, from my vantage point, my personal opinion, it just kicks the can down the road. And it's not enough. We've got to sit down and think about long-term how we're going to deal with this.
I was just wondering, why do you think the general public doesn't see the debt crisis as a crisis? You know, I mean, the Republicans just get their heads handed to them every time they try to stop anything. And I'm not saying Republicans or Democrats are right, but they always lose that battle. You know, like right now, we're coming up to the debt ceiling again, and the Republicans are saying, well, you know, we'd like to tie it to some cuts, and they get no political grip by doing it. They only get their heads handed to them again.
I think it comes down to why is the general public not realizing what happens in the debt picture that's affecting them. And I think a lot of it is coming down to the government is quite large, and there's a lot of people that get many different benefits from it. And it's all across, I mean, it seems like if you go through every industry and every sector, they're getting some type of benefit from the government. Whether it's housing, homeowners, because it takes the tax credit, ethanol, getting a little bit of there. I mean, people would say farmers getting farm subsidies, there's one. You've got oil industry getting their subsidies on that. You've got entitlement payments that are coming in, people that are getting on Medicare, Medicaid, people that are on Social Security, energy, anyway, all these different things, there is some type of subsidy or some type of payment coming to a constituent. And so when you talk about debt, where do you start? My favorite line, so I've been at the university, I've been interacting with the professors and asking them, what could I do? And what I always get amazed about this, is they always say, you need to hold people accountable for their job. I said, yeah, I'm going to hold everybody accountable but you, right? That's what you really want to say. And that's kind of what it is. They want everybody else to lose their subsidy or their payment or their entitlement, just don't cut mine. I think that's the issue. And that's why the comment about shared sacrifice, I think everybody has to pay into this one. And everybody's going to have to take some pain on it. And it's going to hurt. It's not going to be easy. But I think that's kind of where it is. Hank, separately? Or any other?
Just to go with that, that's basically what rolled down. Everybody had their own agenda. Everybody wanted what they wanted, and it just fell apart. It just all fell apart. And maybe not the most optimistic, but this big balloon here, I don't see how they're going to get that shrunk without the nation as a whole wanting to do something about it. And politicians can't do it without backing it up. Everybody's going to have to suffer, or they'll suffer big.
Right.
So it's just,
I'm going to paraphrase for people on the other end of the room what he said was, he says, this is basically, when he was looking at it, you go back to history, it reminded him of Rome, where everybody had their own agenda, and what brought Rome down was everybody wanted their own agenda and didn't think about the collective good. And that it was just got to be too much to the point where it was torn apart by the individuals, and that the collective aspect of it just wasn't able to support it, or wasn't there anymore. And he was looking at this big balance sheet is that to weed that or to shrink that, it's gonna take collective action in many different ways.